in listen-only mode.
Good afternoon, everyone, and welcome to the presentation on understanding the different types of binary options and which one is right for you. Can everyone hear me and can everyone see my screen? If you'll just type in a yes to let me know that you can hear me, I would appreciate it. Thank you, Frank. Okay, before we get started, I would like everyone to take just a moment to read over the Nadex risk disclaimer. And basically, anytime you're trading, there is risk involved, even with binary options. You should never trade with money that you cannot afford to lose. Now, for those of you that do not know me, my name is Gail Mercer, and I have over 15 years of trading experience. I started out with a company that programmed indicators and simply fell in love with the price bars. I do specialize in price action, volume analysis, and divergence because I believe they are leading indicators. I'm also a frequent contributor for Stocks and Commodities magazine, Traders World, and Top Shelf magazine. I've also been a speaker at Traders Expo, Traders World Online Expo, and the Wyckoff Volume Conference. I am the author of Trading Nadex Binary Options Using Currencies, Trading Nadex Binary Options, Keeping It Simple Strategies, and the New Trader's Guide to Trading Nadex Binary Options and Spreads. Any of these can be purchased on my website or on Amazon.com. Now, what is a binary option? It's really just a way to trade that has a defined risk and a limited profit opportunity. It is based on a strike statement, and you either agree or disagree with the statement. For example, the euro yen greater than 128.84 by 6 a.m. Do you agree with this statement? Then you believe it is true and you will buy. Okay. Do you disagree with the statement? Okay. That means the statement is false. In that case, you would simply sell the binary. Now, there are basically three components to a binary option. One is the symbol, and I'm going to highlight this so that you understand. Here's your symbol. This is the underlying instrument. Then you really have your strike statement, which is a combination of the symbol in the price. And then you have the time component, okay? So in this case, we're talking about the euro yen, and the price of the strike statement is 128.84, and it has to be by 6 a.m. Now, the basic components of the binary is important when you enter the binary and you're expecting it to move in your direction. Okay? The value of a binary is constantly changing because price is constantly changing. Either it's getting closer to your strike or it's getting more above your strike if you're long. If you're short, of course, it would be going down. Okay? All of this together determines the value of the binary option. Now, I want you to take a minute and just look at the difference here. This one has 34 minutes and 30 seconds left until expiration. The one on the bottom has 15 minutes and 46 seconds until expiration. Now, prices on the top one, the indicative is at 128.82. Okay. Now, this would be the at the money strike, which is 128.84. Now, because there's 34 minutes left in that binary option, it is below the at the money price, which is 50. Okay, so you could get into this binary for $40.25. That's your risk. And in this case, you would be buying. Okay, now let's go down to the one at 15 minutes. Okay, the indicative price is at 128.89, but look at how much the offer is. That's $85.50 a risk, even though you're only trading about 4 pips, 4 to 5 pips above the strike. Do you see that? Now, typically this would be considered the at the money, okay? But the value of that binary has increased substantially for those that bought it, simply because there's only 15 minutes left until expiration, okay? So you're always looking at the time remaining, the indicative price versus the strike price, and that combined determines the value. Does everybody understand that? Okay. Now, what are your expectations when you buy a binary option? Okay. You expect price to increase. That's what you're expecting price to do. Price will go up in value. Okay. What are your expectations when you sell? You're expecting price to go down. Why is this important? It seems pretty simple, right? Because it all affects the value. And this is where a lot of people, when they're trading binary options, get confused. When you're trading a binary option, you're expecting the value, if you buy, the value will be going up towards 100. Okay? But if you're selling a binary option, you're expecting price to go down from 100. Okay? This has nothing to do with what you get paid if the binary expires in your favor. Okay? This is determined by risk. So in this case, if you see 40.75, this is your risk, but the remaining value is 100 minus your risk. Okay? That is on the buy side. Why do they do that? Because this is going up to 100. Okay? So if you see 40.75 under the offer side, then that is your risk. But on the sell side, it's actually the opposite. Why? Because you're expecting value to go down. For example, if you see 67.50 listed to sell the binary, that means that your remaining value is only 32.50. Okay? It's 100 minus your risk, okay, which is 67.50. Okay? That would be on your ticket. Does everybody understand that? If you're buying, you expect the value to go up. If you're selling, you're expecting the value to go down. Okay? And this allows you to read the risk on the binaries if you understand that concept. Okay, you do have different types of binaries, okay? You have an at the money, and this is where the price is currently trading, okay? Your typical risk on this would be approximately $50. Sometimes it's $45, sometimes it's $55. Depending on exactly where price is at, okay? You're out of the money. If you're buying, it is a strike above the at the money. If you're selling, it is the strike below the at the money. Your risk on an out of the money binary is typically less than $40. What about in the money? Well, if you're buying, the in the money strike is typically one strike below the at the money. If you're selling, it is typically one strike above the at the money. Okay? A deep in the money is if you are buying, it is two strikes above at the money. But if you're selling, it is two strikes above the at the money, because you're selling, it's going down. It's usually the highest risk, which means it's usually greater than 70 to do a deep in the money. Now, this can vary also according to how much time you have remaining in the binary option. Okay, so this is binary strikes that were available on a 2-hour binary expiring at 7 a.m. Your at the money generally will remain the same. It's the one right around the $50 mark. You can also see that over here you have the indicative price index. This is what determines whether a binary pays out or not. In other words, the at the money strike in this example is USD JPY greater than 107.10 by 7 a.m. Okay? Now, if you believe that the price will be greater than 107.10 by 7 a.m., and currently it's about 1.3 pips above that, then you would pay $56.75 because you expect the value to go up. Okay? Now, let's say that you don't think it will be greater than 54.50. In that case, you're going to sell, which is clicking on the red 54.50. Now, what would your risk be? That would be 100 minus, because it's going down, 54.50. Okay? So in this case, the risk on the short side would be 46.50. Sorry. Does everybody see that? So this is your profit potential, because there's $54.50 of value remaining on that binary option. But on the buy side, it's already valued at $56.75. So you have to subtract that in order to determine how much value is still remaining. Do y'all understand that? Now, where is the at the money? Again, it depends on whether you are buying or selling. Okay? If you are buying, then your at the money binary options will be above. Okay? So this is your at the money. You could have 14 is out of the money, 18 is out of the money, 22 is out of the money, 26, all the way up to 107.50. Now, could it move up to 50 in 1 hour and 20 minutes? Probably not, unless there was a market report coming out at 6:30. Okay? We don't have 6:30 market reports, so more than likely it won't go up that high. Okay? What if you are selling the binary options? Your at the money remains the same. It's still 107.1 because that's your $50 mark right here. Okay? But below is where you're going to get the out of the monies. And this is if you are selling. Okay? So all of these would be out of the monies if you are selling. Okay? Now, these down here, if you're buying, could also be in the money. Okay? So you have 74.50, 87, 94.25. This is your risk. Now, which one does not make sense to buy? The 97.50, if you buy that, what is your profit potential? By the time that you pay for the binary, there's nothing remaining that's really profitable for you. Okay? No, it's 50 cents. That's what's remaining. You would, if you decided to buy this one right here, you would make, after you pay the exchange rate, you would make 50 cents. Okay? Now, if you did the next one up, you would have basically about $4. We're just going to round these off. That's about $4 of profit after the exchange fees. On the 107.02, basically you would have $11 remaining after the exchange fee. 74.50, you'd basically have about 25 remaining. Okay, after the exchange fee, it makes it 23. Okay, this is why you should be able to calculate, because at a glance you can actually see which one has the potential. Now remember, this is for buying. Everything above is out of the money. Everything below the at the money is in the money. Okay? These are only out of the money if you were selling. Okay? Now, this is selling. The in the money would be above the at the money strike. And again, just look for your $50 range. That usually is going to be your at the money. Okay? Anything above, if you are selling, will be an in the money strike. Anything below where the at the money is considered out of the money strikes. Again, sometimes you can actually get some really good deals by looking at the ones that are below price. Okay? Some of my favorite ones to actually trade would be like the euro dollar, the USD JPY, the Aussie dollar. They are all 4 pips. And if you look at this, you can see the difference. The at the money is at 107.10. The next strike below it is 107.06. Now, if you look at the premium, this one is 54.50. This is 68.75. So in other words, if this is the at the money, okay, and price manages to move down 5 pips in an hour and 20 minutes, if your bias is long, you're going to pay just about $32 for that binary. That means you have about $68 left for profit. Do y'all see that? Now, can the USD JPY move, in essence, 5 pips in an hour and 20 minutes? Typically it can. And each of your currencies will have a different strike width, and that's what that's called. The difference between one strike to the next strike is your strike width. So some of these that have the lower pips, like the USD JPY, the euro dollar, the Aussie dollar, the USD Swiss franc, I mean, it's very easy for them to move that little bitty 4 pip strike. Now, binaries always pay out $100 if the price expires in the money, which is in your favor. The profit is always 100 minus your risk paid on entry. You can always exit early. I think they do have a cutoff. It might be the last 60 seconds immediately prior to expiration. But normally, if you have a target set, it will still fill if the value gets to what you have as your target. How can you gauge the profitability if price moves 1, 2, or 3 strikes in your favor? Well, it's all in the premiums. If you buy a binary to enter, then you must sell to exit the position. Or if you sell, then you must buy to close the position. Okay? Now, the next few slides are based on a random trade generator with 600 random trades based on profitable percentage combined with a risk to reward ratio. And there is a $2 exchange fee. And everybody in the room should be tracking their own trades, and they should actually know what their profitable percentage is. If you know that and you know your average risk versus your average reward, then you can actually do the math and work out whether your strategy, as it is, will be profitable over time. To do that, you simply take your total trades and you multiply by your profitable percentage. That gives you the profitable trades. Now, if you take and you multiply the profitable trades times the risk to reward, times the average reward, and then subtract the losing trades times the average risk, it will give you your gross P&L. Then you multiply your total trades times your exchange fee, which is $2. Subtract that from your gross P&L, and that gives you your net profit and loss. For example, if you had a 55% profitable percentage with 100 trades at $50 risk to reward ratio, which is a 1-to-1, you simply multiply 100 times 0.55, it's 55 profitable trades. 55 times 50 minus 45 times 50 equals 500. 500 minus 200 for the exchange fees gives you a profit of $300 after 100 trades. Now, let's say that you were using a risk to reward of 1-to-1, okay? Your percent profitable is 55.17. After 600 trades, this could potentially be your equity graph, okay? Now, let's say that you're running a 1 to 0.33 risk to reward ratio, okay? In that case, if you're able to achieve 80.5% profitability, then this could potentially be your equity graph. What if you were using a 1-to-2 risk to reward ratio? After 600 trades, if you were able to achieve a 40.82 profitable percentage, then this is what your equity graph could look like. Now, one thing about it, if you're using a 1-to-2 risk to reward ratio, you need to make sure that you keep your risk very low so that you have the profit potential of making a 1-to-2 risk to reward ratio. Now, which type of binary is best for you really depends on a lot of different factors, okay? What is your risk tolerance? What is your experience level? What is your historical performance? What is the typical market movement for the market that you're trading? And what type of trader you are. trend versus counter trend. I can do both. I tend to go more towards counter trend, just because I like them more. But again, counter trend, you can have more losses than wins. And this is where you really have to work out the risk to reward in your favor. Any questions? For those that would like to visit my website, it is tradershelpdesk.com. My email is gm@tradershelpdesk.com. If anyone has any questions after the presentation, you can always email me. Any questions at all, guys? The indicative price index is based on an average of the last, I believe they do 10 prices, Joseph. Most of the time it'll be the same as what the underlying is trading at. Any other questions? All right. Thank you for joining me. I hope all of you have a wonderful day. And what's better for non-events trading? You mean at the money, out of the money, or in the money? Spreads or binaries? I don't think it's as simple as, okay, spreads are better for trading non-events and binaries are better for trading the other. I think it's more about the pattern that you're trading and what type of market action you're expecting. I use spreads when I'm expecting a big movement. But, if I'm expecting the summertime laws, is what I call them, summertime blues in the market, I'm probably going to use a binary because we don't get as much movement, especially during August, is what we would get, say, October. October is usually a big month for the markets. Right now, everybody's trying to get their kids off to college and all that stuff. The one with my books, sure. Oh. There you are, Abel. And I have a new one that will be coming out in September on candlesticks. And that one will actually, I'm designing a video course as well for candlesticks. But I don't have it ready yet. Thank you. Any other questions today, guys? Okay, I would like to thank everyone for joining us. I hope everyone has a wonderful week and weekend, and I'll see you the next time I'm in the webinar room.